All right, everybody, Event Trader here, Gavin, and being joined by our lead analyst over on GrowX, Robert Reid. How are you doing today, Robert?
I'm good. How are you?
I'm doing good. Just kind of watching the markets here. You got any general market thoughts before we break into some of these names?
Yeah, it just looks really positive. I mean, I don't, I'm not quite sure what to make of it, to be honest.
Yeah.
But the nice thing is that it's just kind of like a steady rise. I don't think it's been like a massive spike like we saw in January, and that had that huge sell-off in February. So, since like May, it's just been a nice and steady climb for the market. So I'm generally bullish here, but we'll see what happens. But
Okay, yeah, no, I think that seems to be the general thought process at the moment, and obviously we'd like to see a little bit more volume get in and a little bit more participation rather than just that slow, low volume bleed up that we're getting now. But certainly a lot of good information out there and a lot of positive data. And with that in mind, we're going to break into some of these names that you've been looking at. I know you've highlighted a few of these on the site, so we're just going to take the next couple of minutes here for you to expand a little bit on your thoughts. And first off, we're going to start off with Signet, who I believe, if I'm correct, report next week, right?
they do, Thursday before the open.
Yeah, Thursday before the market opens. Now, certainly a turnaround play here. I know they've had some divestitures that I'm sure you're going to break into, and a change in results that's allowed this stock to bounce from that 36 area that we saw back in April to 61 here, about a 80% rally in the name there, 75% call it. A lot of that was following their last earnings report, which they were able to spike up and break through that 200-day moving average. Haven't really looked back since then, and have been trending up nicely, running into a little bit of resistance at 64. But why don't you break down the name a little bit for us here, Rob, and tell us what we should be looking for next week.
Yeah, actually, this name is actually our number one in our yield leaders report, which is our Bit Plus report that looks a lot at share buybacks and dividends. Relative strength is not really part of the equation, so you can find some nice discounted names that haven't run too much in this report, so I really do kind of like it. We publish it every Friday morning on the Bit Plus page. And so basically with Signet, I kind of dug into the story a little bit, and which is the largest retailer of diamond jewelry. They have 3,500 plus stores. They own a few brands you're probably more familiar with, like K Jewelers. They own Zales, they own Jared, Ernest Jones, and a few other smaller ones. And you're right, they are in turnaround mode. So basically they've had a few things that have been working against them. One of the biggest things is a lot of their stores are in malls. And as you know, mall traffic is down just for the effect of Amazon, online purchasing. There's just less traffic in malls in general. And they have a huge mall presence. So they definitely have been impacted by that. So that's been hurting them. Another aspect that's been hurting them is that they used to, well, just recently they changed their policy here. They used to actually issue credit for, obviously diamonds are expensive purchases, so they would actually underwrite the credit. That doesn't mean accepting a Visa or MasterCard. They would actually underwrite the $10,000 credit, for example, for a diamond jewelry. And they would have
a similar business model would have been when GE had their GE Capital unit, basically, right?
Yeah, kind of. Yeah. They became like a lender, but it's not really their core competency. I mean, they're a retailer, so they've been too involved in the purchase, in the process of the actual purchase, and that's part of what their turnaround has been about. They actually have been selling off their credit portfolios to like large investors. So at this point, they pretty much have washed their hands of it. Now they're basically just focusing on being a retailer, which is kind of what they do. So
does that have any impact? Because I'm assuming the reason why they would have done it was for cheaper financing. Does it have any sort of impact on their pricing?
It does, and it also kind of binds customers to them. It's basically, just kind of like or people might buy different jewelry over the years and they have an account with them already. It just kind of creates more customer loyalty. It just kind of binds the customer to them. But the problem is that it just creates too much financial risk, and it creates fluctuations from quarter to quarter in terms of the credit worthiness of their portfolio. And it's just
right.
not
and just the valuation, I would assume, of that portfolio probably.
Yeah, it is, but their multiple would also be lower because it's harder for investors to get their hands, like their brain around. Well, what does their balance sheet really look like? What are their real risks? So it just kind of made investors just nervous that they're getting into that they were doing the actual credit themselves, the underwriting of the credit. So another company like this was Con. I don't know if you remember CONN. They also had a similar thing. I think Rent-A-Center does is. I think more and more companies are getting out of the credit business, and they're focusing more on retail. So another thing with this is another reason they did it because these are large purchases. I mean, diamonds are obviously very expensive, and there might be customers who may not be able to get credit for something like this, but they want to get the sale done. So Signet might be more open to. Letting the purchase go through with maybe less, with perhaps not the greatest credit in the world. So, but anyway, the point is that they're getting out of that business, which I think is a good thing. The other part of the turnaround that they're doing is they're closing a bunch of stores. It turns out that about 75% of their stores have another banner in the same mall. For example, there might be a Kay Jewelers, and then another part of the mall there might be a Zales or a Jared. So what they're doing is they're kind of pruning it down to get rid of a lot of the duplication, and that way it'll save a lot of money in terms of rent costs and things like that. So and they're also
it is funny because I know I did a small look through some of the yield names that you have on the 21st, and this was a name that I did like, but I was kind of laughing when I saw like you're saying the amount of cannibalization, because I would have never known that Kay or Jared or whatever were.
They're like, oh, they're humongous. I've heard of Signet, but I didn't realize that they'd own all these other different brands. So basically that's. But the problem is a lot of these they're so mall based, and just the mall traffic is just down. It's just hurting them a lot. So they're going to reduce their square footage in terms of floors. They're also focusing more on digital sales. I think they're around 8% now, and their goal is to get that up to 15% by fiscal 2021. So they want to double their digital percentage in a few years, so that's a good thing. They're also been sort of beefing up their brand positioning. Like they're kind of separating, like Kay is for like a treasured relationship, Zales is for high fashion, and Jared is sort of a one-of-a-kind love kind of thing. They're trying to break out and differentiate the brands too. That's another big part of their strategy. But so it's so as you can see, they have quite a bit going on in this transformation. But the biggest thing is getting out of the credit operations. I think is a big deal. And then just on a final note, just real quick, and the reason I really like it is the management team has been extremely aggressive in terms of buying back stock, which I always think is a great sign of the quality of a company. Is that if management, they're actually putting their money where their mouth is, and they're using that excess cash to purchase stock. In fact, they have a 14.1% buyback yield. And so that's kind of what put them on number one on our yield leaders list.
Yeah, and that's on top of a 2.4%.
Correct.
Dividend, right?
Yeah.
And just as a heads up for people that want to follow along, Robert did a nice write-up for this that posted under the yield ticker at 1238, where about 6 bullet points down you could see exactly this buyback. But yeah, go on, Rob. I mean, that's definitely a nice part of this story.
Yeah, the buyback is a nice part of the story. And actually the proceeds, because they just sold some of their credit operations in the July quarter, they're going to use, it's like $445 million. They said the bulk of that is going to go towards share repurchases, so that's a good sign. And in fact, they said it's actually about 475, and they said about 60 million of that was spent in the April quarter, which is the first quarter. So that means still another 87% of that is yet to come in Q2, Q3, and Q4, because they're going to spend that money this year. So there should be a lot of share buybacks there probably was in July quarter, and I imagine there will be in Q3 and Q4 as well. So that should help support the stock price. And so overall, I like it, and it also trades at a reasonable PE. They're expected to earn about $4 a share this year, which means a PE of about 15.3, which is attractive. So anyway, so I think it's a good buy and hold for long-term holders. You might want to hold off. Let's see how this July quarter report comes in next week. It might be a little messy because of that sale of the credit operations. So there might be some unusual items in there. It might, so you may want to see where the smoke clears after the quarter. But it's definitely one that I like for long-term investors.
Yeah, that's funny, actually. That was the exact comment I had. I'd prefer to let this tape go because, like you said, there's going to be a lot of noise and it's going to make for some headline risk.
Yeah, there might be like a big gain on sale or some accounting adjustments there.
Gain on sale, and plus just this buyback will probably throw off some of that EPS as well. I mean, they might beat by 5-6 cents, but a lot of it could be driven by those share buybacks.
That's a good point. That's true. That's a good point as well. So.
What percentage of the revenue do you know was their credit business?
I'm not exactly sure on that. All I know is they sold their one of them for about $500 million. So it was a pretty big part of their business, but now they pretty much have washed their hands of it at this point. So they're fully outsourced credit. So basically now when someone wants to buy diamonds, they'll refer them to this company that bought all the credit off them. So they're not actually underwriting the credit themselves, which I think is a smart thing.
All right, so there we go. We'll certainly be looking for follow-up commentary on SIG. That's one that we'll be concentrating on. What's actually kind of a busy week for earnings next week. But that'll be one that I'm sure, Robert, that you're looking at, and we'll be looking for any follow-up commentary. Maybe we'll come back around after earnings and have you give us a quick recap.
Will do. Sounds good.
All right. Next up on the list is one that I've got in the portfolio here. I've been a fan of it for a while. Another nice turnaround play, and that is Target, ticker symbol TGT, of course. Just came out with earnings earlier in the week. Had a nice round of earnings there. Certainly another turnaround play with their store reorganization. We've seen some pretty good performances from some of these, lower-end retailers, if you will, or thrift. I don't want to put them in the Dollar General or Dollar Store category, but the Walmarts of the world, Costco.
Like the mass merchandisers, yeah.
Yeah. So this one broke above 82. Had a bit of selling just after the report, but now we have it back, and it's pushing up towards that 87 area, and what's just a really nice looking chart here. So you want to take us through a little bit on the Target story?
Sure. Actually, this is another name it's been in our value leaders on our Bit Plus page for the last year. Not every week, but it's been kind of off and on. But it's been a mainstay over the last year and a half, perhaps. And I've liked it. I think it's a good stock here. I think this earnings report was really impressive. I mean, their comps, their same-store comps, which is always very important for a retailer, was up 6.5%, which was its best comp in 13 years. Their traffic growth was 6.4%, which was by far their strongest since 2008 when they started tracking traffic. So this was a huge quarter. People are definitely coming in, and I have to admit that I was a little bit of a skeptic when I heard about this transformation early last year in 2017. My first thought was like, oh, really? Okay, so you're going to redesign the stores a little bit. And that's not going to fundamentally change the difference. People are still going to go to Amazon to purchase things. But I kind of thinking maybe I was a little wrong. I mean, I think based on not only this quarter, also the April quarter was huge too, in terms of traffic and comps, and I think maybe they can do it. They are redesigning all the stores. They've spent a lot of money pushing their digital and quick pickup, or whatever you call the mobile pickup, where you could just pull up into the driveway. They'll come out and bring out your stuff to you, all the stuff you want. So. And I believe they also have 2-day delivery. I know Walmart did that. I think Target did too, but I'm not 100% sure about that. But anyway, my point is that I think these retailers, they've actually taken some steps where I think now they actually can compete much better with Amazon. Walmart had that big quarter last week, and the digital sales were the big driver there, and then also now with Target. they had this impressive quarter. I guess people are coming in the stores. I mean, the only concern is I hope that it's not just a one-time blip because of the remodeling of the stores. I hope that they can continue this nice growth over the next few years.
Yeah, I'd be surprised if that was it. I know I go to Target all the time. I don't really have a Walmart by me, and I know when they first did the reorg, I was kind of scratching my head, and like the aisles seemed really small and stuff. But now I don't even really think about it. I just think, hey, there's a Target there. I know there's a lot of stuff I could get. So.
I agree. I mean, I was just skeptical. Like, yeah, they can fix up the stores, make it nicer, do this and that, but it still didn't change the fundamental problem with just online purchasing. It's just convenient. It shows up at your house in 2 days. So I was skeptical, but they're proving me wrong. I mean, I think that they can actually claw back some business from Amazon, so I got to give them credit. And it's been 2 quarters now for Target. They had a big April quarter, now July, so it kind of gives me confidence that they can actually make some headway here.
Yeah, and again, one thing that I've noticed is everybody that was putting in the money in the 2015, 2016 for that digital, be it Walmart, Nordstrom's, Target. I know that they're not all on the same level, but seems like those people that were a little bit earlier and doing the money spent on the digital growth are definitely really reaping the benefits now. And Target seems to be one of those in those plays. We've seen Walmart take off, and JWN too, of course, had that big quarter.
But yeah, it's definitely paying off. I mean, it has taken a little bit of time, and it's still going to, take another couple of years. I mean, and also Target is still redesigning a bunch of their stores, so it's not over yet. But definitely the early returns are really impressive. Much better than I thought this early, to be honest. So, I tip my cap to them for sure.
What are you looking at as the key metric moving forward here, Robert? Is it comps or
comps and traffic? I mean, it'd be really important.
Sales too.
Digital sales too. Sure. But it's still a small kind of percentage of their business, but that's definitely a metric to watch as well. But for me, the next biggest thing will be, let's see how they do a year from now. Once they start lapping this big traffic and comps, that'll be the real test. I know that's a little bit farther out, but I want to see how they lap these big quarters in the first half of this year, what they do in the first half of 19, to really get a sense for, is this a sustainable phenomenon or not. So, but anyway.
So would you be looking more at a quarter-over-quarter sequential comps as a better read than the year-over-year because of those easier comps?
No, I'm a big believer in year-over-year comps because retail is so seasonal. You have to look at the same time period each time. I mean, they might get a boost because Q3 includes the back-to-school season, whereas Q1, Q2 didn't. So I wouldn't necessarily compare them that way. I would compare back-to-school versus back-to-school the year before to really. I mean, you can look at the sequential. It does kind of give you a sense of just a general overall, but I do prefer the year-over-year in terms of comp and traffic growth.
All right, and just so people are aware, certainly some mixed opinions, it seems, out there. I've seen Telsey Advisory Group, who are really great in this space, just yesterday upgraded the name and put a $100 target, and that's basically what I'm looking at for target. But then we also have a downgrade from Wolf Research to Pure Perform, and I'm assuming that's on valuation. I didn't have a chance to take a look at that, but following this run-up, we're definitely seeing a little bit of mixed measures mixed opinions out of the analysts, but still liking the name myself here, Rob.
Yeah, so. I like it, and it pays a nice dividend too. I think it's 2.9% yield. Yeah. So that's a nice little kicker you get too.
Yeah, that's basically how it kind of fell on my radar. Is just a dividend play here, especially with that 10-year pulling back a little too, because that's back to 2.8. So next up, Robert, we're going to take a look at Pepsi. Yeah. Obviously, they had that big COO change, which certainly garnered a lot of attention, and they got it. It's been a couple of weeks since they got it, but I guess the big news, of course, is that SodaStream acquisition, which was a name that you are very high on. Very nice job there for the users. Anybody that followed Robert in on that one certainly got a nice set of returns. But why don't you tell us a little bit about Pepsi and the SodaStream acquisition?
Yeah, SodaStream has been a long time emerging growth member. It's been on and off in the rankings, but I think we started tracking it back in like 2013 or something like that when it was in the 30s. It did take a big hit a few years ago. They made a big change. I don't just they do the at-home like water carbonation systems, and they used to focus on sodas. So if you want to have a Diet Coke or a root beer or something like that, you would use it in SodaStream. But it just turns out that people, at least the American consumers, it's always been big in Europe and other parts of the world, but the U.S. market was always what they really wanted to get into. That was because we drink so many beverages, like carbonated beverages in the U.S. So that was always their goal, was to get into this market. And to be honest, the soda, it just didn't take off here. I mean, we actually tried it here at Briefing. It didn't taste that good, to be honest. I mean, also the syrup it was always difficult to clean the filter, and
I was never a fan of it.
I was never a big fan of it. And people are very particular about their sodas. They drink Diet Coke. They want they always drink the exact same brand all the time, and they don't want to go to a generic Diet Cola, to save a few pennies. I mean, I just don't see it happening. So basically the point is that it didn't really go anywhere. So they made the kind of a big change coming 2 or 3 years ago, where they became a sparkling water brand. So they just threw out soda altogether. They're doing flavored sparkling water. And it's been a huge, they've just had huge sales since they made that. It was a really smart switch, and it's really paying off for them. And like sparkling water's just been great in general. These brands like LaCroix and Polar Water and Bubbly, there's been some really, consumer tastes are definitely moving more towards that, away from, they want more natural and away from the chemicals, and it's a better fit in terms of what the American consumer, where their trends are going, and what they're more willing to use a soda machine for. So I think, like, for sparkling water, I think people are a lot less brand married to their brand in sparkling water than they are with sodas. So it's been a real big success. I mean, the stock has been really taken off. And what's nice about it is that it's not just the sale of the systems. This also creates a recurring revenue stream, sort of like the blade and whatever you call it, the blade, where basically you sell the handle and you get all the blades in the future. The same thing with this, is where they get to sell the flavor packaging and also the gas refills. So there's an ongoing recurring revenue aspect to the business.
What's the valuation that they paid?
I think it was high. I mean, to be honest, I was a little surprised. The premium was only like 11% it closed on that Friday. I think it was announced.
But it had that big run up.
It did. But in fairness, that run was not because of takeover speculation. That run was because they earned it with earnings and with great numbers. Typically, those big runs, if they're related specifically to an acquisition rumor or a report from maybe the Wall Street Journal a month before, then I would include it in that. But this actually, they did that 32%. They did that big move on its own before. I didn't hear rumors that Pepsi was thinking about taking them over. At least maybe I just missed it. So I was surprised that I think they could have got a little bit more of a premium, but you're right. I mean, the stock has run, almost a third in the last 30 days before the deal was announced. So, shareholders have been nicely rewarded, especially in the last few months or so.
Right, and then of course we're going to have a change in top at the top with
I'm sorry. Go ahead.
No. Go ahead. So I'm going blank on her name. Indra Nui stepping down, and the global operations chief, I believe, Ramon LaGuardia, is going to be stepping up. As you said in your comment a couple of days ago, back on August 20th, if anybody's looking, Robert put together some nice color on the SodaStream acquisition. As you had mentioned at that point, it's a little odd, the timing here, but obviously this had to be in the works, right?
Yeah, that's what I think. I mean, my first thought was, I was shocked when I heard this because, Pepsi, their CEO just announced she's stepping down, I think it was just a few weeks ago, and they announced a major acquisition like this into a new area. It just was I was just surprised that they would take on such a big change when there's like a CEO transition phase. But you're right. I think they have been probably discussing this for a long time and analyzing it, and they went ahead with the deal. It's just. It was just a little surprising to me, but I think it's a good deal for them overall, and I think it's also this might actually speed up. A lot of people have been clamoring for Pepsi to break up its snack business and its beverage business so they can get better multiples, because their snack business is doing really well, and their beverage business has kind of been more of a laggard. It's kind of holding down the snacks business. So I think this will accelerate the separation of the two segments at some point. And I think the new CEO might also, that's another factor that might be doing it as well. So you have a couple of big changes going on. I think I don't know when they might announce it, and they may not. I'm just thinking that it seems to me like that would be a lot of heavy lifting if you're looking to do an acquisition and then do spin-offs all under new leadership. There'd probably be a little bit of a discount to the name, I would think, just based around that level of difficulty for execution. Yeah, I would agree with that, but I think that it also puts I think it makes the beverage segment much more attractive if once they become a separate company. Okay, we also have SodaStream in here, so I think they have other brands, obviously Gatorade, orange juice. I forget which. I don't have it in front of me. What are the other brands? But they own several brands. But I think this will kind of put like a nice icing on the cake.
Polar Water, they have too, right?
No, I don't think they own them. I think they're just those are just competitors.
Okay.
Sparkling water, yeah. But I think that this actually this deal I think will make a separation more likely, because I think the beverage segment will be more exciting as a separate company if they own SodaStream as part of it. So I think that actually might be a small indication that they are considering splitting the two up.
So prior to this acquisition, the hang-up was the concern around the strength of that beverage business.
That wasn't the only concern. I mean, it was part of it, and I think just it might also just been the CEO. She didn't want to do it, but now they're getting a new CEO, and I think at some point they're going to separate the two businesses. But time will tell on that. That's
something we'll keep an eye out on. Stock's down about 4% since the acquisition announcement, which isn't a terrible decline at all. And it's still holding above its 200-day moving average, which stands at 110.86. It broke above this back in early July when they reported earnings. So moving forward, obviously the potential for a spin-off or a breakup of the food and beverage business, but what are some of the things that we should be watching in Pepsi moving forward here, Robert?
I think it's going to be more headline-driven in terms of any development of separating the two companies. I think that's kind of what's going to be the catalyst to get it going. I mean, their earnings are generally pretty much in line, maybe some nice upside. They don't tend to, they're such a huge company with such a huge brand. They don't have massive ups and downs, but I think separating the two companies would be a big thing, and to kind of see once the new CEO takes over, to kind of see what direction, you kind of read into what he says. I don't know if they're going to have a particular, like a special conference when he takes over, or certainly that first earnings where he's in charge. That would definitely be listening to the commentary on that call to kind of get a good direction as to where this company's going to go. But overall, I'm a fan of Pepsi. I think it's a good buy for like long-term holders. I think it's attractive and good brands, and I think a separation would be a positive thing.
Okay, that sounds good. Do you like Pepsi over Coke, the stock, not the...
Well, I like the drink on a Coke better, but...
you got to buy what you know, right, Rob?
Exactly. But I like the snacks on Pepsi, so that's probably not healthy either way.
There you go. And Pepsi, just so people are aware, I don't know if you had mentioned it, a nice little dividend yield here at 3.3%, right? So
yeah, something like that. It's a nice
that's
yield.
some nice income for you as well. But okay, fantastic. Well, Robert, we'll definitely have you back on next week, certainly with a follow-up to that Signet play. Ticker symbol SIG, which, as you mentioned, reports earnings next Thursday morning. And as we stated, looking for a potential noisy print, but that should hopefully let us get in at a cheaper level. But Robert, thank you very much for coming in and joining us. Any parting shots before you go?
No, I think I'm all good. Just want to wish you have a nice weekend.
All right. Yeah, you have a great weekend too, Robert, and we'll talk to you soon.
Sounds good. Thank you.
Okay, bye-bye.